What if I told you that one of the world's sharpest investors think the United States is sleepwalking down the same path that led to the Great Depression? And no, he's not just talking about a run-of-the-mill recession, he's talking about something a whole lot worse. Ray Dalio, the billionaire investor whose firm navigated the 2008 financial crisis, has a stark warning for 2026. He believes we're heading for a financial heart attack that could send gold prices into the stratosphere and twist interest rates into knots. So what does he see that others are missing? More importantly, what does it all mean for your money? We're going to break down his exact predictions and why he believes a crisis is coming that almost no one is ready for. Before we get into the heavy predictions for 2026, we've got to understand who Ray Dalio is and why when he talks the entire financial world leans in. Dalio isn't just some guy on TV, he's the founder of Bridgewater Associates, a hedge fund that started in his 2-bedroom apartment and grew into the biggest on the planet. His success wasn't a fluke, it was built on a deep, almost obsessive mission to understand how economies really work. One of his biggest ideas is that history moves in cycles. He's poured decades and massive resources into studying the last 500 years of economic history, searching for timeless patterns that drive the rise and fall of empires. This isn't about fortune telling, it's about mapping the cause and effect relationship that have repeated for centuries. It's this very method that allowed him to see the 2008 global financial crisis forming. While most of the world was caught by a surprise as bank collapsed, Dalio and his team were prepared because they had studied the Great Depression and recognized the parallels. They saw the mountain of housing debt was a classic bubble waiting to pop. While others saw a party, he saw the warning signs. Now his track record isn't perfect. Critics will say he's called for crisis that didn't happen exactly as he thought. But even those past warnings were rooted in the same problem he sees today. Way too much debt. He warned about it in the 80s and again in the 2010s, and while he may have been early, the problem he flagged, spiraling debt, has only gotten bigger. Today Dalio believes the clock has sped up. He argues we're no longer in early innings of this problem, we're at a breaking point. He sees a major debt crisis, his economic heart attack hitting within the next few years around 2026. Give or take. And this time he warns that the fallout could be even bigger than in 2008. So what exactly is this economic heart attack Ray Dalio keeps talking about? It's a powerful and frankly scary metaphor for the final painful stage of a big debt cycle. Think of credit as the economy's circulatory system. Money flows like blood, fueling spending, investments and growth. When the system is healthy, debt is used for productive things and the economy gets stronger. But Dalio says the United States is now in the danger zone. The country is spending way more than it earns in taxes, creating huge budget deficits. To plug the hole, the US government issues a flood of treasury bonds. For a long time this has worked just fine. Investors here and abroad were happy to lend the US money. The problem, Dalio argues, is that this debt is starting to act like a plaque in the economic arteries. The US national debt has surged past $37 trillion and the interest payments alone are becoming gigantic. The government is now on track to spend $1 trillion a year just on interest. That's money that can't go to infrastructure, healthcare or anything else. It's just the cost of past borrowing. This debt burden squeezes the rest of the economy just like a plaque constrains blood flow. The heart attack happens at a tipping point when there aren't enough buyers for all the new debt being sold. Imagine the US Treasury trying to sell a fresh batch of bonds, but the big buyers, foreign governments, central banks, starts to get nervous. They look at the mountain of existing debt and ask, is this still a safe bet? When demand dries up, it's a classic supply and demand nightmare. To lure the remaining buyers, the government has to offer higher interest rates. This is where the spiral starts. Higher rates make the interest on the entire national debt more expensive, which makes the deficit even bigger. This forces the government to borrow more money at even higher rate. It's like taking out a new credit card just to pay the interest on an old one. Dalio warns we are very close to this point. When the debt becomes so big that the government is forced to either print insane amounts of money or just default on its promise, that's the economic heart attack. And this isn't just a theory, Dalio insists, that what we are seeing today isn't new at all. It's a pattern that has played out for centuries, from the Roman Empire to the British Empire. He specifically compares the current US climate to the late 1930s and the 1970s, two periods of massive economic instability. Let's look at the 1970s. The decade gave us stagflation, a toxic mix of high inflation and a dead-in-the-water economy. Just like today, the government had been on a spending spree, geopolitical tensions were high and confidence in the US dollar was shaky. People holding cash or bonds watched their savings get eaten alive by inflation. In that chaos, hard assets, physical things things like gold did incredibly well as people scrambled for real store of value. This all fits into the master framework, the big debt cycle. Understanding this is key to this whole argument. Dalio has mapped out the typical stages empires go through over 50 to 100 years. It starts with stages 1 and 2, when a new world order begins. One country becomes dominant, its currency becomes the world's reserve, hello US dollar, and it can borrow cheaply. This leads to stage 3, the debt bubble. Easy credit feels a huge boom, stock prices and real estate soar and everyone feels rich, but under the surface the wealth gap widens and the country borrows more and more to keep the good times rolling. Dalio says we've been in this stage for decades. Then comes stage 4, the bubble pops. That was 2008, but the response to that crisis, printing trillions of dollars and slashing interest rates to zero, was just a band-aid. It didn't fix the debt problem, it just moved it from a private hands to the government. That brings us to stage 5 and 6, which is where Dalio thinks we are right now, printing money and the fight. The government is now the one with the crazy debt level and the central bank prints money to help pay the bills. This devaluates the currency, sparks inflation and leads to intense political fights over a shrinking economic pie. This all builds up to the final stage, a debt and political collapse. This is the financial reset people talk about. It is either a massive currency devaluation or a default, and it completely changes the world order. This is the heart attack. This is the crisis Dalio is predicting for 2026. He warns that because these cycles take a whole lifetime to play out, most people never see them coming and are left totally unprepared. Now, here's why this is so important. Getting a grip on these cycles is the first step to protecting your own finances. If you're finding this breakdown useful and want to stay ahead of these massive economic shifts, do yourself a favor, hit that subscribe button and ring the notification bell. I'll break down complex financial topics like this every day so you can make smarter moves with your money. So if we are really staring down the barrel of an economic heart attack, what's an investor to do? Where do you park your money when the system itself feels shaky? For Dalio, a big piece of that puzzle is one of the oldest, most trusted assets in human history, gold. And he's not talking about a tiny symbolic slice of gold. Dalio recently stated that investors should think about holding around 15% of their portfolio in gold. To put that into perspective, a typical financial advisor might suggest 1, 2 or 2%. If any, a 15% recommendation is a huge statement about the level of risk he sees. So what's his logic behind this? Well, first, Dalio sees gold as the ultimate diversifier, an asset that does well precisely when stocks and bonds are getting hammered. He points out that most investments are credit dependent. A stock depends on a company's earning, a bond is just a loan, they all need the financial system to work, but gold is different. As Dalio says, gold is the only asset that somebody can hold and you don't have to depend on somebody else to pay you money for. It's not a promise of payment, it is the payment. That makes it a powerful anchor in a storm of currency devaluation and political chaos. Second, in a world where governments are printing money like there's no tomorrow, gold is your shield against currency debasement. The logic is simple. When the Fed creates trillions of new dollars, each dollar you hold buys a little less. But gold can't be printed. Its supply is limited. That's why during the high inflation periods like the 1970s, gold's price tends to soar as paper money's value sinks. While Dalio avoids giving exact price target, his warning and bullish stance on gold are echoing across Wall Street. Gold has already had a historic run, surging past the $4,000 per ounce mark this year. This has prompted analysts at major firms like Goldman Sachs to raise their forecast, with some projecting gold could hit as high as $4,900 per ounce by the end of 2026. This isn't just a wild guess. It's based on expectation of continued massive buying from central banks and investors who are all seeking a safe haven from the dollar. This looming debt crisis also has huge implications for interest rates. Like we covered, when there are more sellers of government debt than buyers, interest rates have to go up to attract money. This isn't just a government problem, it sends shockwaves through the whole economy. Higher interest rates means bigger mortgage payments, pricier car loans, and higher costs for businesses. It's like slamming the brakes on the economy. Dalio believes the Federal Reserve is trapped. If they let rates rise to attract bond buyers, they could crash the economy. But if they keep rates low and just print more money to buy the bonds themselves, they risk runaway inflation and killing the dollar. This is the no-win situation of a late-stage debt crisis. The most likely outcome, extreme volatility and chaos in the markets. In this unstable world, another more speculative opportunity comes into focus: silver. While gold is the king of monetary metals, silver has a unique dual identity. It's part monetary asset, part critical industrial metal, and that industrial demand is exploding. Silver is essential for solar panels, electric vehicles, and AI hardware. Historically, silver's price has been tied to gold, a relationship called the gold-silver ratio. Right now that ratio is stretched, meaning silver is historically cheap compared to gold. Because the silver market is much smaller and more volatile, when money rushes into precious metals, silver often takes off and dramatically outperforms gold. This has led some bullish analysts, and let's be clear, this is speculative and not Dalio's direct prediction, to suggest that silver's performance could massively outpace gold's by 2026. While it's a riskier bet, the logic is based on silver's historic undervaluation meeting a surge in industrial demand. If Dalio's crisis plays out and the rush to hard assets could light a fire under the silver market. Let's bring this all together. Ray Dalio's message is both a stark warning and a call to get prepared. He sees the US heading for a predictable debt-fueled crisis by 2026, an economic heart attack born from decades of borrowing more than we can afford. He believes this will trigger rising interest rates, wild market swings, and a potential financial reset that could scramble the global economic map. His solution isn't to panic, it's to prepare by understanding these historical cycles and making your portfolio resilient. He strongly argues for a serious allocation to gold around 15% as a strategic anchor against currency failure and systemic wide risk. And for those willing to take more risk, silver's historic discount presents a powerful, though more volatile opportunity. Whether these things unfold exactly as Dalio predicts or not, his core message is a wake-up call to all of us. It is a challenge to think critically about our financial future and take our economic education seriously. Because in an era of record-breaking debt and uncertainty, the best investment you can possibly make is in your own knowledge. And don't forget to drop a comment below with your thoughts on Dalio's predictions, and I'll see you guys in the next video.